Rohr here with an early, concise highlight on Wednesday, September 10th, 2014. It's currently about 7 a.m. U.S. Central Time, and very interesting developments that mean we're going to be concise today because we're only going to touch on a couple of key changes based on the weakness in Asia on the foreign exchange, and essentially look at the equities and fixed income that have had more critical movement since yesterday morning's early global view. Well, looking at how the S&P acted yesterday, that was essentially pretty firm all day holding up. It finally got back down below that key 1990 to 88 zone we had been talking about for some time now. And to show you how that has become even more important after the multiple tests of that area, let's expand the hourly chart here on the left. Along the way, the market has formed an awkward sort of head and shoulders pattern. And just to be clear, that means in some cases those are not all that reliable, and we have reached a very critical juncture on minor slippage but not much follow-through so far, as the market's sitting off about 1.5 points right now, right into 1988, after having traded down to 1986. But of course, with the low yesterday having been 85, that's really not that much more confirmation. This down break out of the head and shoulders, again, that'd be the left shoulder, kind of muted, a very extended, awkward, lopsided head, and the right shoulder over here, based upon the pullback lows at right into 88 and then last Friday into 89 during regular trading hours, this down break is from right around 89.5 area or so. We're actually calling it right at 89 just to be on the safe side. But the key to this pattern is because it's awkward, there's more of a sense it might not be a bona fide pattern that's going to see the follow-through down to the objective at 1968. And don't forget, along the way, there is further support around 1978 to 75 from the major congestion during the trading range that occurred through most of July. So we'll be keeping an eye on that. But for right now, we have to look at this 1989 area down break and say, is it real or not? And the last bounce high before the down break was up here at 1999. That's going to leave 2000 area as an important level, along with the fact the market gapped down yesterday from just about 2000. And secondly, the high of the right shoulder up at 2650 is the ultimate tolerance of an attempted down break. Much above that, market's probably ready to push on, and the higher resistance, of course, will be up around the 2020 area on the weekly oscillator and topping line this week, as we have already noted. We also note the indicators are finally getting more critical, with the hourly MACD right down near the lower runaway band. And if this market should take more pressure, there is reason to believe it could feed on itself. But even as far as it's come down, now that the breakout's in, there's a bit of a burden of proof on the bears to show they can knock it further and get all this downward momentum to feed on itself. And that pretty much does it for the short-term view of the S&P 500.